We are entering the period where the unsophisticated novice type trader, or even hedge funds that are afraid of underperforming, will start to really chase the market. The fear of missing out is going to be intense. And even though, if you could think logically, you would realize that this is just really stupid behavior at this point. This intermediate cycle it's either 19 or 20 weeks. They usually run about 22 to 25 weeks, and of course you got to have a few weeks for the move down into the for the declining phase of the cycle. So if you can think logically, then it's just stupid, dumb to be chasing this late in a cycle. This late in a cycle, the correct strategy is just to sit and wait and be patient, because these type of runaway moves produce a crash at the end of the cycle. So if you're jumping in now because you're afraid that you're going to miss any more of the move, you force yourself to accurately pick the top, which is darn near impossible to do. And if you don't pick the top, then these things, and I'm going to show you an example here in a second, these things can literally lose months of value in a matter of 3 or 4 days, sometimes in the matter of a minute. So let me show you an example right here of a runaway move and the crash that followed. So here's the runaway move into that pre-COVID top. And you can see it just, day after day after day going up and up and up. And any correction is bought up and up and up. Buy the dip, buy the dip. These convince people that there is no risk, but there is actually huge risk. You can see how far this was stretching above the 200-day moving average. And then, something happens, some little piece of news, whatever it is, it starts the profit-taking event. And most traders just assume that you got, this dip is the same as every other dip. It was a buying opportunity. And then we gap down, another warning sign. But traders have been trained to believe that these are all buying opportunities. And then the market opens higher the next day, but then sells off. And so what happens is over 6 or 7 days, you lose, let's see here. It looks like it's about 4 months. You lost 4 months of gains basically in 6 or 7 days. That's what happens at the end of a runaway move. Now, to our current market, it's much more dangerous than what we saw there during the pre-COVID run-up, because the price has gotten stretched much, much further above the 200-day moving average. So when the profit-taking event begins, there's just a lot more people that have been chasing this thing. So there's just piles and piles of stops built up all along this parabolic structure that are going to get hit on the way down, which intensifies the selling, and that's what causes the crash. So you definitely need to fight against this desire to chase this move this late in a cycle. Unless you have a crystal ball and you know exactly where the top's going to be, you risk getting caught in the crash where I've just shown you that literally 4 months of gains can disappear in 5 or 6 days. And since this parabolic structure is much more extreme than what we saw there, the crash could be even bigger. You could literally watch this market go from stretch obscenely far above the 200-day moving average to all the way back down to the moving average in 3 or 4 days. It's just waiting for that piece of news, or whatever the trigger will be that starts the crash. No way to know ahead of time, but It could be something as innocuous as just, maybe a bellwether company missing earnings a little bit, or maybe giving forward guidance that's not quite what the market wants to hear. And so, some of the longs start to sell, and then it just starts to trigger those stops, and then down it goes. So no way to know exactly what the trigger is going to be, but it's for anybody that is sophisticated and understands how these markets work, you understand that this is a very, very dangerous market, with probably with upside potential, but that comes along with the requirement that you're going to have to be able to pick the exact top to make sure you don't get caught in the crash when it starts. So the more intelligent investor will just leave this alone. There's no need to chase this. Once the crash comes, then that's where you want to buy. Energy is looking interesting. Let me go over to energy markets. We've broken back above the 200-day moving average. It's looking interesting, but it's also kind of in this similar position to the stock market, in that it's really late in this. This looks like one daily cycle, so it's really late in this daily cycle, and I expect that when the crash starts in the stock market, it's going to drag the energy markets down too. But that's where you want to, we definitely want to be stalking the energy market, so that when it corrects, probably along with the stock market crash, then that's where you want to be buying energy, because it's I think all the confirmation is there that this is the 3-year cycle low, and we're probably ready to build out the right side of this cup and what I think is probably going to be a cup and handle pattern. So let me widen this a bit. So I think probably what's playing out is this is the left side of a cup basing pattern. We're going to form the right side, then probably a little handle, kind of similar to what gold is doing, and then we'll take off. And I'm on record as saying $200 oil is going to be a piece of cake. But once we get our correction here, wherever it comes, then I think you want to buy energy, because I think we're about to start the advancing phase of the right side of the cup, where we're kind of mirroring what happened on the way down. But it's too late right now. It's way overbought, and with the risk in the stock market, it's probably going to drag oil down with it. So once we get a correction, that's your buying opportunity in energy markets. The market that the smart investors are focusing on is the metals market. We're just we produced a decent gain here in the first part of this first daily cycle, and we had a contract roll out to December, so this is a little bit misleading. Let me go to the August contract, because it's a little bit different looking chart. All right, so here's the August contract. So we made some decent money on this run up, and now we've taken some profits, and we're kind of sitting on the sidelines. I want to see what's going to happen here. Sometimes these first daily cycles will just turn out to be a wild whipsawing mess that has to come back down and test the intermediate cycle low before it can start to get some real momentum during the second daily cycle. It could also just, this could be just a correction into a half cycle low, and we're ready to start getting some upward momentum now. But I don't know in this position, it's hard for me to tell. I'm going to have to see a little bit more to decide whether or not it's time to get aggressive on metals, and that this first daily cycle is going to start producing some nice momentum, or whether it's going to be choppy for a few more weeks before that momentum develops. So that's where we're at in the metals. We're just kind of stalking this market, waiting for a sign as to whether or not the momentum is ready to appear and give us the move up to test these all-time highs in preparation for a breakout. So smart money focusing on this market, dumb money chasing stocks and energy, and setting themselves to get caught in the crash when it occurs.